Good evening, ladies and gentlemen. You're watching the evening news on News Now with me, Sumita Karir. We'll over the next 30 minutes, we'll of course go over the top stories of the day. But beginning this show with some breaking news coming in as far as India's GDP data is concerned. In fact, the provisional estimates of the annual GDP for 2023-24 and quarterly estimates for Q4 of 2023-2024 have really been released. Now, the real GDP has been estimated to grow by 8.2% in FY23-24 as compared to the growth rate that was seen of 7% seen in FY22-23. Moreover, we are also learning that the real GVA has grown by 7.2% in 23-24 over the growth rate of 6.7% that was achieved in 2022-23. And of course, we'll keep giving you as and when we keep getting all of those numbers. But let's first go across to our experts who are joining us live on the show and get their perspectives on the initial set of numbers that are just trickling in. So we're now joined by Govinda Rao, who's a Chief Economic Advisor, Brickworks Ratings, former Director, NIPFP, and Aditi Nair, Chief Economist, ICRA. Also, Devang Shah, the Head of Fixed Income Axis Mutual Funds. Thank you very much, ladies and gentlemen, for joining us this evening. I want to first get your thoughts and your first comments on the number that's been out, that of 7.8% for Q4 FY24. If each of you could start. Let's first begin with Govind, then we'll go to Aditi and Devang. Govind, can you give us your first reactions and what is your overall assessment of the number that's come out, given that we've only seen a positive commentary, a bullish commentary coming in from multilateral agencies. S&P ratings also elevated India's credit rating stance as well from stable to positive. Now, what do you really make of the numbers, Govind?
I think it's good news. I think it's much better than what the market expected. Sort of 7.8% GVA growth, 7.2% GVA growth is much better than what everyone expected. So, in that sense, actually this 8.2% is more or less similar to the average that you had in the last 3 quarters. So you have, in fact, people were expecting it to be sub 8%, but then it's more than 8.2%. That's a good news. And that has happened in spite of the fact that I'm sure agriculture must have fared very badly. But my own feeling is that the manufacturing must since the base numbers were very low last year in the last quarter, things must have improved much better there, both manufacturing and services sectors.
Right. Let me now go across to Aditi. Aditi, in fact, that's exactly what, we've also been observing. The street was estimating quite a conservative number, but this is coming much better than what was expected, although it has moderated a bit as far as Q3 was concerned.
Absolutely. The way we had done the calculation was we had estimated GVA first, and then we had looked at what the likely gap would be between GDP and GVA growth in this quarter. And therefore, we had arrived at our forecast of the GDP number. Now, first of all, GVA growth is higher than what we anticipated, but so is the difference between the GDP and GVA. The wedge that we had forecast was about 100 basis points, and what's come across in the provisional data today is 140 basis points, and therefore there is an even wider gap between the GDP growth number and what was forecast by us, which was pretty close to the median for the market. Now, there are a lot of revisions in the earlier data. I've not been able to look at all of the numbers closely, but I can tell that at least the agricultural numbers seem to have been revised. For instance, for Q3, the initial estimate was a contraction, and now it looks like a 1.1% growth. So we're obviously we'll have to go back and go through all the sector-wise, quarter-wise numbers to get a better sense of, what to make of this quarter's number. But one thing I think that one of the reasons we were expecting growth to moderate sequentially was that the commodity price benefit for margins has been going away over the last few months, with commodity prices kind of catching up to their year-ago levels. And that's something that stood out when I was very quickly going through the release, that the industrial sector growth is peaking in Q2 and then coming off in Q3 and Q4. And I think a large part of this is the commodity price story.
Right. Let's now go across to our third guest, Devang. Thank you very much for very patiently waiting it out. Your first thoughts, and I also want to get your view on the impact that RBI's expected RBI's dividend payout that was higher than expectations. That how much of an impact is that going to have in the GDP of FY25 Q1?
Sure. So, see, first of all, the number is quite positive, as I think both the other panelists spoke about, and it's significantly higher than what we also anticipated. But we are also looking at GVA, and the GVA number is ballpark somewhat similar to our expectations. We were close to 6.1, 6.2 number, and the GVA has come 6.3. On an overall perspective, though this number continues to be on the higher side, we need to look at the internals, but yes, the manufacturing sector seems to be good, and the corporate guidance continues to be better. From a bond market perspective, I think this number would not have a significant impact on either side. Markets are now looking at what's happening on the policy front. As you rightly pointed out, people are waiting eagerly for the election results. And if we get the government back, I think somewhere down the line, the thought process across is that what would be the impact of this additional dividend which RBI has declared on the fiscal math. Our assessment is that with the entire outlook on India being upgraded by S&P on the rating front, we believe somewhere down the line, there's a high possibility. And if you actually look across at the internals of the S&P release, they speak a lot about fiscal consolidation, give a lot of merit on growth and fiscal consolidation. So our assessment is that if we get the current government back, they might look at fiscal consolidation and probably paves the way for some bit of borrowing cut in the second half of the year. Our assessment on borrowing cut is close to 50 to 75,000 crores, possibly in this year.
Right. I want to, go back to Mr. Rao. Mr. Rao, I mean, of course, there's a lot of focus. There's been a lot of focus this year on some of the sectors like defense, manufacturing, power, railways, etc., infrastructure as well. How do you see, FY25 really shaping up as far as a policy push by the government is concerned? Of course, the markets have really been factoring continuity. They've been saying that if the current government, the current dispensation comes back to power, it's going to be positive for the markets and, of course, for all of these sectors. Keeping all of that in mind, how do you really look at the economy faring?
Well, I think the good news is likely to continue into FY25. That's because agriculture is going to be much better than what it was in, it was in FY24. There is a good news about the weather forecast, the rainfall, and obviously the agriculture is going to do much better. That will also cool prices to food prices to a considerable extent. And then this RBI dividend, which you mentioned earlier, is going to help both in compressing the fiscal deficit as well as keeping up the capital expenditure which the government has been doing in the last 2-3 years. So the government has a target of compressing the fiscal deficit to at the union level to 4.5% by 25-26, and this will help in that matter. So all in all, and obviously there is nothing to prevent. There are no immediate shocks, additional shocks. There are already some shocks, but the additional shocks that are likely to happen. So the economies, the buoyancy in the economy is likely to continue into the FY25.
Right. So you're saying that buoyancy in the economy is going to continue, and it's all going to be, all good as far as the Indian economy is concerned. I want to go to you, Aditi, and really, understand what do you really make of then the rate cut cycle. How soon or how later can we really expect that to come in, considering that's really what everybody's focus has been on?
Sure. Firstly, if we look at the rate cut cycle, I think June pretty much is off the table for even a stance change or any kind of major change in commentary indicating that rate cuts are imminent. I would say that even August is now becoming a question mark. If growth is this strong, then why do we need rate cuts unless we're completely convinced that inflation is going to trend down to the 4% mark and stay there over a period of time. Now, by August, at least we'll be halfway through the monsoon season. So we should be in a better position to extrapolate from those trends to how the food inflation trajectory is likely to pan out. So I won't rule out a stance change completely from August, but I would certainly say that with growth this strong, the likelihood of even a rate cut in a stance change in August and a rate cut in October has actually gone down.
Right, and Devang, what do you make of the rate cut cycle? Of course, Aditi has shared her perspectives as far as a possible rate cut is concerned. Do you really expect that, considering that the numbers are really showing resilience? The numbers have been great. We've also seen commentary coming in from multilateral agencies as far as India's economy is concerned. Do you expect that to be advanced a bit, rate cuts?
So I agree with Aditi here. At this point of time, looking at the growth outlook specifically, I think RBI will not be in any hurry to cut rates. Unless and until we get a complete handle on inflation, they would want to be conservative just before the onset of monsoons. So our perspective is if monsoon goes well and probably we are going to the trajectory close to 4%, they don't see any kind of sustained risk on inflation. Because the growth is good, I think they will be slow and measured in cutting rates. Our assessment is also similar. Probably we're looking at the second half of the year for rate cuts.
Right. So second half of the year is what you're factoring in as far as rate cuts is concerned. Let me go back to Mr. Rao. Mr. Rao, let's now speak about the risks to the economy in FY25. You've of course spoken about how the Indian economy is resilient. Consumption is picking up. Several sectors are really getting that policy boost, that much needed policy boost from the government, along with that RBI dividend that only makes things easier for the government in terms of spending. But what are the downside risks to economy that you see in FY25 playing out?
One of the interesting things that I see in the last few years is that the economy has got quite a bit of immunity from many of the risks that you see. You had external risks, you had oil price risks, and you had a practically bad monsoon last year. And in spite of all that, the economy has done reasonably well. So I do not really see a major risk coming. And obviously, since the economy has acquired a certain degree of immunity, for various reasons, I do not see a major risk happening. I don't see another COVID happening soon. So I think I'm not going to be very pessimistic on that.
Okay, you're not going to be sounding very pessimistic on that, but Aditi, what about you? What are some of the challenges that you really see? Mr. Rao was mentioning about that geopolitical conflict playing out in the Middle East, but aside that, any other risks that you see?
Be as optimistic as Dr. Rao, I will offer some risks that we need to be watchful of. First of all, right now on the monsoon side, what we've got in the latest forecast from the IMD is indicating a pickup in rainfall in the second half of the monsoon season. Now, typically, that's when the standing crops are already there in the fields, they're, growing. And if you have concentrated bouts of very heavy rainfall, that's actually not very good for the standing crops. So we can't completely rule out that there could be intermittent, bouts of heavy rainfall that actually end up being slightly damaging. So I think climatic issues is something that we have to remain watchful of, particularly for agriculture and also for, the implications for the wider economy and inflation. In particular. Second thing, there are going to be some transient factors that are going to have an impact on quarterly growth rates. I haven't had a chance to look at the fiscal data yet. We got the provisional data for March and April, I think, while we were on the air. So I haven't been able to look at that. But I did see the core sector data that came out around 5 o'clock. And cement growth has actually pretty much flatlined in the month of April. So with the elections underway, we do think that Government of India's capex is going to be slow in this quarter. And that's perhaps what has really brought down the cement sector growth so much. It just grew by 0.6% in the month of April. So intermittently, we are going to find some impact on some sectors from the parliamentary elections and model code of conduct, but this is transient. This will reverse itself and we will see a pickup in the second half of the year. My concern is that even if we channelize the unexpectedly high RBI dividend to higher capex, can it get absorbed in the number of months that we have left after the full budget is presented and once the monsoon is over? Because typically it is hard to really push out a lot of capex activity during the monsoon months. So can we absorb such a high amount of capex in, let's say, 6 to 7 months of FY25? I suspect this is going to be a year which is going to be easier to show a larger amount of fiscal consolidation. And next year is when we're going to see higher expenditure. So a higher fiscal multiplier would be coming in the next fiscal year. And, concomitantly, it's going to be harder to sustain fiscal consolidation in FY26 as compared to FY25.
So you're saying that it is going to be difficult, for that fiscal consolidation to be maintained, but at the same time, you suspect no big dramatic changes, no big dramatic challenges for the economy. Then Devang, let me come to you now. Then can we expect this, 8% growth in the next 2-3 years to sustain itself as far as the India growth story is concerned?
Yeah, so see, first of all, we are doing quite well. So from a relative perspective, when we look across at the rest of the world, let's look at the developed markets. I think probably China is struggling, other emerging market economies. We are actually far much more better placed. So at this point of time, from a macro perspective, are we in a Goldilocks period? Completely agree with that. Obviously, I think both Dr. Rao and Aditi spoke about it. I'll probably echo some of the sentiments of Aditi as that. I think my personal view is somewhere down the line, the best of the growth cycle in the near term is somewhat behind us. We are seeing somewhere down the line of a roadmap towards fiscal consolidation. And all of us we understand that once fiscal consolidation or the fiscal impetus reduces, it does impact growth. We are also seeing financial and credit conditions to start getting tighter. RBI has been very, very proactive, and wherever somewhere down the line they anticipate some kind of issues in future, they're probably tightening somewhat or adding some bit of guardrails around it. So I think the CD credit growth should see some bit of tapering off. Thirdly, I think the way we are seeing measures at the Chinese economy and probably some bit of impact of that on commodities. We've already seen a 20-25% increase in commodity base metal prices over the last 3 to 4 months. And this can be a worry for us in future. So our perspective is somewhere down the line, the best of the growth in the near term should be behind us. Yes, that doesn't mean we are significantly going to slow down. Our assessment is probably for the next 12 to 18 months, we should be hovering around 6 to 6.5% kind of growth numbers. And that should be good from a macro perspective.
Okay, so Mr. Rao, let me come to you. I think everybody's been watching and waiting with bated breath on the next big event after election counting. I want to understand from you in terms of the upcoming budget. How do you think these numbers will really influence the upcoming budget? I brought this point earlier in my conversation with you about RBI's super bumper dividend that was given to the government. Will that really translate into a big capex announcement or big policies being announced? Because Aditi was also mentioning a very important point that this is going to be monsoon season. So any development activity in the near term will be curbed. What is your assessment in terms of how this number is going to impact and influence the upcoming budget?
Well, I mean, with the additional, dividend from the Reserve Bank of India, as I mentioned, a part of it will help in the fiscal consolidation process, because in the interim budget, not adequate provision has been made for many in many of the, particularly in the revenue expenditure side. So some of these things will be made, with the better revenues that you have. And so I would think that they're not going to make a great deal of difference in terms of fiscal deficit target. 5.1% was the deficit that was given in the interim budget. I think they will stick to that. And to the extent they have a little additional revenue, they will possibly put it for capital expenditure. And again, one of the good things that we see is that the GST has settled and then the revenues have been increasing. And of course, we should see what the revenues. I mean, April is the month where obviously you get a lot more revenue for various reasons. But then there is a shift in the GST collection, and also the buoyancy in income tax has also been reasonably good. So they should have sufficient, sort of comfort this year. But then, as Aditya mentioned, possibly next year, and then year thereafter. Next year, things are not going to be that easy because you have to make a significant, compression in fiscal deficit. Also, there will be one other problem, because I think the rate cut cycle in the West, particularly advanced countries, is likely to be advanced with the inflation under control, and that could have an implication on the external finance, possibly the financial flows, and so that's something which needs to be looked at. Otherwise, I think the 2025-26 is not. I'm sorry, 24-25 is not going to be that bad, and we'll have to see how the things work out for 2025-26. It's too early to say.
Well, we'll have to wait out for how that really plays out. But for now, Indian economy is growing at 7.8%. In fact, it has grown by 7.8% in Q4 FY24. And thank you very much, ladies and gentlemen, for your analysis of the numbers that have come out, the GDP numbers that have come out, and the factors that are going to further influence the Indian economy. Thank you very much indeed for joining us this evening.
If you like this video, then like, share and subscribe to ET Now.